First things first, relative strength in regards to industries has nothing to do with the RSI indicator. I guarantee you there's at least one person in here that didn't know that. So the RSI indicator is a completely different thing than when we refer to relative strength in between sectors and industries, all right? Industry relative strength in this study refers to the performance of stocks within the same industry. Each industry is compared to other industries daily and ranked for performance, all right? So the RSI indicator has absolutely nothing to do with anything we're about to talk about. It's just a way to rank sectors and industries against each other. The results are startling. Imagine that. If you want to make money in the stock market over the longer term, so this is more of a swing trader, position trader, long-term investor standpoint. Obviously, it matters with day trading as well, but not as much. So as short as a month to as long as 2 years, but probably longer. Pick stocks from the top industries, preferably from the industry showing the best relative strength. Avoid selecting stocks from the industry showing the weak or the worst relative strength rather, unless you are looking for stocks to short. Since some stocks within an industry can be hurting, you will want to be selective and choose the strongest relative strength among them too. Right? This is stuff we preach every single day, but now we have Bulkowski on our side screaming at us that yes, this actually makes sense. Let's figure out why. So the methodology, which I spelled wrong. Bulkowski created a database of industry relative strength beginning from January 1st, 1995 to November 9th, 2007, and that's actually when he started this study, 2007. So he's updated it since then, but we're going to go over the stuff that he went over starting from 95 to 2007. The starting date was arbitrarily chosen, but he wanted to include the 2000 to 2002 bear market, so it's nice. We're getting a bull market, a bear market, a bull market. 512 stocks were placed into 44 industries with between 5 and 23 stocks each, but most had an average of 10. Then measured the close-to-close price change over the prior 6 months. The total price changes for stocks were used to find the average percentage change for the industry and ranked each industry, right? So this is what we do with Koyfin every day. This was before Koyfin was around, so he did everything with... he has a program called Patterns. It's free, actually. It's like basically a Windows 95 version of Koyfin. No need to go check that out, but if you want to, feel free. But he does what Koyfin does for us. He ranks all of the data. Once the database was built, he split the industries into 4 groups. Those that ranked 1st to 11th, 12th to 22nd, 23rd to 33rd, 34th to 44th. So there's 44 different industries that he looked at. And essentially, he tiered them. Tier 1, Tier 2, Tier 3, Tier 4, based off of relative strength. For performance over time, he looked at 3 industries within each group. So if the first tier, he would look at maybe the top 3, second tier, the top 3 there, etc. The best performing, the middle industry, and the worst performing. He then projected future performance. For example, if the drug industry was the best ranked industry, he computed the average price change for the industry from its initial date to 1 month, 2 month, 3 month out into the future. All right? So it's a forward-looking study here. This is not a backward-looking. Remember the volume stuff? Volume was more backward-looking, right? We're looking at past results. This is a forward-looking study that he's trying to build here with this hypothesis. Does relative strength build future performance? All right? This is not a perfect study by any means, and we'll go into that at the very end. But this does a very, very good job at shining light on one of the most underrated, in my opinion, parts of trading. So we're going to look at the results to begin with. So we see that Group 1, Group 2, Group 3, and Group 4. You see all the different tiers. You see that the ranks within those, and they're segregated, 1 month, 2 month, 3 month. You can see that the top portion of Group number 1, that were ranked 1st to 11th in relative strength over all the other industries, on average, rose 8% in 1 month, 15% in 2 months, 23% in 3 months. 23 fucking percent on average. On average. Now go to, let's say, rank 23 to 33 and go down to 3 months. 3%. That is an incredible edge in the market. This little table here is showing you that the top ranked relative strength industries, and within those industries, the top ranked stocks vastly outperform everything else. Literally everything else. Now this is a bull market, a bear market, and a bull market. So you're getting a little bit of everything. Really, I should just stop this here because this pretty much proves to a certain extent that relative strength should be taken seriously if you are looking at stuff on a week-to-week, month-to-month basis. Not necessarily day trading, but you generally want to trade with the trend, so find the industries that are trending upwards, and you can find day trading opportunities within those. But if you're a swing trader at the very least, position trader like what JJ is attempting to do, holding things for months to quarters. If you're long-term investing, Mike is dabbling in this. Mike took a bunch of his money and put it into Vanguard Value in his long-term portfolio based off of the rotation into value. This is what we are talking about. So this table right here is starting to build this case. Yes, the industries that are outperforming all of the other industries do, on average, outgain everything else by a very large margin, by the way. Now I want to look at from the short side really quick. Look at group 4 and look at the stocks that tend to underperform. So if you're looking, let's say, to short something, does it make sense to short the weakest stocks in the weakest industries? Some would say yes and some would say no. I would have tended to say yes, and this tends to agree, but not as much as I thought. So yes, looking at the middle rank to bottom ranks are the best. I would have expected more of a runoff, but the markets are built to move up. So shorting the weakest performing industries is an edge, at least based off of these statistics. Not as much as I thought, but still. This is 6 month, 9 month, 1 year, and 2 years. Once again, we don't need to go over this. You can read it, screenshot it if you want. The performance is fucking incredible. On average, over 2 years, the stocks rise 98% in the best performing industries and only 12% in the worst. And in the worst industries, on the bottom side, if you're shorting, down 25%, 1 year down 33%, 9 months down 32%. So yes, longing the industries that are outperforming everything else is viable. Shorting the industries that are underperforming every other industry is viable. All right? So, results part 2. This is what I said. He updated this. Another test was run using data from January 1st, 2000 to May 18th, 2008 on 550 stocks, but not all stocks were covered the entire period. The test showed that you get the best performance by buying the 3 top-ranked stocks in the top-ranked industry and holding them. Now it's a little different for us because we are actively managing something, so we are going to be selling them, and we'll go over that in a second. But in his term, he means almost never selling them. Just buy the things that are fucking winning and hold them forever. In the case of Apple, Tesla, things like this, Amazon, you would have made a shit ton of money, right? Would you have rather traded Apple over the last 20 years or just held Apple over the last 20 years? Probably just held Apple, right? This result may be due to the bear market coming first in the test, followed by a bull market. The best test sold the stocks in the industry when the rank dropped to 45 or below out of 48, so it is very near the bottom. That gave an average hold time of 610 days, or about 1 year and 8 months. So once again, I want to point out, this test was not necessarily with a swing trading or a position trading edge in mind. His exit system was strictly based off of when the industries fell out of favor, which you don't need to use as a trader. You can use any other stop loss system you want, volatility, percent, dollar amount, moving average, anything you can think of. This was strictly based off of relative strength, and that was to keep the test clean, I guess you can say. Just buy the things that are winning and then let them, or sell them when they stop winning based off of one variable. I respect him for doing that. It makes things a lot easier to understand, but seeing that he held through some of these huge losses, I didn't put this in here, but I think his biggest drawdown was 98% on one of his profits. You don't want to hold something and watch it, especially if it's spot, watch it come back 98% on you. So not the best stop loss system, but it is one of the best buying opportunities. The series of tests performed showed that buying 3 stocks per industry worked best, followed by 4 and 5 stocks. 1 and 2 stocks were farther down the list. From a money management perspective, it says to diversify in an industry, but owning too many stocks in the industry is bad, especially for a trader, right? We do not want to over-diversify, right? We do not want to. That's not our goal as a trader. As an investor, Sometimes over-diversification is bad as well, but it tends to do better for long-term investors to diversify. As a trader, diversification can take away an incredible opportunity that we spot in the market. So do not over-diversify is what this is saying. The sweet spot somewhere is between 4 and 5 stocks. If you guys have seen, sometimes when I go into sectors or industries, sometimes I'll buy the ETF, but I'll also buy 1 or 2 of the companies within the ETF that are outperforming every other thing within that sector or industry. This is why. You can grab the broad gambit, the sector or industry, but also focus on the stuff inside that is outperforming everything else within that sector and industry. Incidentally, the stocks chosen in each industry were the ones with the best stock relative strength. All right, so I was just talking about that. Thus, each additional stock was performing less well when added to the database. So obviously diminishing marginal rate of returns. When you get down to the 5th, 6th, 7th, 8th stock within that industry or sector, it's going to be underperforming when compared to the 1st, 2nd, and 3rd stock inside that industry or sector. Duration. How long does an industry remain top ranked? Bulkowski looked at the rank of all industries and determined how long they remained within the group as an average. The best and worst ranked groups showed stocks remaining in the group nearly double groups 2 and 3. Why is this the case is unknown, but the best appear to keep performing and the worst keep suffering. If you want to beat the market, buy the things that are beating the market, and what do we always say, especially when we hit big blue skies, all-time highs, stocks that are in motion tend to stay in motion. And Bulkowski is saying, yes, he totally agrees. The best continue to be the best. The worst continue to be the worst. He does not know why. And as traders, we don't need to know why. We just need to know that that's the paradigm that we're trading through. Buy the things that are moving up, sell the things that are moving down. The actual duration is shorter than he expected, between 21 and 47 days, which honestly was a lot shorter than I thought as well. But that's perfect for a swing trader, if you think about it. If the top-ranked industries continue to outpace all of the other industries for the average of in between 21 and 47 days, that is legitimately the swing trade sweet spot. You cannot get any better than that, actually. And on top of that, if you're buying options and you're looking at that 45-plus DTE, that's even better. That's more ammo for you. Bull market duration from January 1st, 95 to October 9th, 2007, excluding the bear market from 2000 to 2002. Average length, you can read them. 47 days was the average for the top-ranked industries. And then the bear market duration down below, 39 days. So, once again, buy the things that are beating the market. And if you want to go short, sell the things that are inversely correlated to the market, right? The biggest underperformers. So now I want to take the next 5 minutes really quick. You guys don't have to say anything. But we're just going to look at some of the Koyfin charts that show us the industries. This is not sectors. Sectors was the sectors that have been trending over the last 10 years are still trending well up until you go to like the 3 months where energy just blows it out of the water. So industries is a little bit more interesting. So I want to pull these up and just go through them really quick and see if this idea makes sense. And also, I want to frame it in the outlook of what are you trying to accomplish as a trader based off of your system. If you're a swing trader, what's your time frame? If you're a day trader, what's your time frame? If you're a long-term investor, what's your time frame? All right. So, for example, 10 years. This is going to be somebody that's building a portfolio to retire on. Obviously, the number one thing you should have bought, SMH, your semiconductors. Over the last 10 years, this has outperformed everything. And as a matter of fact, look at what's underperforming everything and what I'm in right now. OIH and XOP have underperformed over the last 10 years, whereas SMH has overperformed. Now, if you were to go and buy SMH 6 months ago, this chart looks amazing right here. Would you be happy with your returns if you bought SMH 6 years ago, or 6 months ago rather? Probably not. We'll see that in a few charts. So just because the 10-year trend is absolutely monstrous does not mean that the 3-month trend is monstrous. And so if you're a swing trader and you're looking to hold things for a few days to a few weeks, this chart doesn't matter a whole lot, right? But to somebody it does. And so you're going to get a lot of different opinions, and they're going to say, well, if you're not buying SMH here, you're an idiot. Well, maybe their time frame is 20 years. Maybe they're building a long-term portfolio, right? 5 years. All of a sudden, SMH drops to number 2. PBW, your clean energy. We've been talking about PBW for like the last 3 months. TAN comes in at number 3, your solar energy. I'll be honest with you, when I pulled this up, I did not realize PBW and TAN would be number 1 and 3 over the last 5 years. Had zero idea, like at all. But here we are. Once again, oil is down. Even jets. I can't believe, look at jets, the airlines. Everything that you think is great has been underperforming for 5 years, besides SMH. IGV, your software companies. FDN, your internet companies. These are outperforming everything. XRT, your retail. Let's move into 3 years. Now we're really starting to get up there with PBW and TAN. Outperforming fucking everything. Once again, I had no idea. But look how long PBW and TAN outperformed. From April of last year, I guess, until like February of 2021, that went on a fucking rip. And prior to the coronavirus crash, it looks really small because of how big PBW and TAN ran up. They were still leading the market prior to the coronavirus crash. So it wasn't necessarily an outlier to say they were leaders. They were leaders before the crash. But look at what happened during the fucking run-up to January and February. It's incredible. If we would have bought, JJ and maybe Ian traded TAN last year. They made the right fucking call. I don't remember if I traded it, but we had it charted. We talked about it all the time. But this is what relative strength can do. They traded TAN when it was leading the market way back in like, I don't know, August, September. And look how much it fucking ran. So kudos to both of them. I don't know if either of them are here, but go back 1 year. We see the PBW spike. We see the TAN spike. Everything else. Now look what's starting to come into fashion. Oil, all of a sudden. So go back 1 year. Now all of a sudden oil's up there. So 10 years ago, 5 years ago, 3 years ago, oil is shit. 1 year ago, all of a sudden oil starts popping up. OIH and XOP. Now all of a sudden they're in the top 5, top 8. Let's go to 3 months. Now where's oil? Top 5. What is this? 3 of the top 5 are oil. Metals are number 1 and number 3. Your gold miners. So now you can see trends change. You see the relative strength in the market start to change. So if you would have bought, SMH 10 years ago, you'd be up fucking huge. But let's say you're not looking to hold it for 10 years. You're looking to hold it for a month. Now which one do you want to buy? Not SMH probably, right? 1 month. OIH and XOP absolutely killing the market. Whereas everything else is kind of fluctuating around SPY. Not a whole lot of big winners other than OIH and XOP. So if you're looking to hold something for a couple days to a couple weeks, and you believe Bulkowski's data, you would expect to be looking at the top third of these industries: OIH, XOP, XME, AMLP, GDX, KRX, or KRE rather, and not TAN, ITB, PBW over the last month. Let's go even closer, 5 days. Now we're getting down to what I say, 5 days does not confirm a trend, but if something is moving in a certain direction over 5 days, pay attention, because it could be the very beginning of a manifestation of a trend change, right? So OIH and XOP, once again, 5 days up. PBW as well. So these are the 3 that stand out to me: PBW, XOP, and OIH. Now, as a swing trader, are you buying based off of a 5-day chart? Maybe, you could. It would be more of a risky entry, but this is the beginning of a potential trend change. And if you're swing trading, that's what you're looking to grab, that trend change. That's it. Now, you don't need to hold it for a quarter like a position trader or a business cycle like a goddamn investor, but if you want to catch a breakout, catch relative strength, 5 days is where you're going to want to start looking for hints. And that's what Kevin did with PBW. He's in the trade right now in PBW because we saw the run up over the last 5 days. Now, let's say you're a day trader. The 5-day chart may give you an idea of what to look at, but the 1-day chart is what you're going to be looking at. So as a swing trader, I post this in the group all the time, but I don't really give a fuck. Unless I'm actively looking to open a position that day. I don't care if, GDX, for example, I got stopped out of GDX today. But I'm not looking at this chart and sweating. Like, it broke down out of a pattern that I was trading and I got stopped out, which is fine. But I post this for the day traders that are looking to make plays because, hey, you might want to be trading Apple or Microsoft or something, but maybe if you're looking to go long in something and not actively looking to go short, you should be looking at OIH, KRE, XOP, these things. So as a day trader, you might start here and say, okay, I see a trend throughout the last 5 days. What's happening today? The trend is continuing. Maybe OIH is the place to look at. As a swing trader, we're looking at the 5-day to make this type of decision. 5-day starts, 1 month, and the 3-month, or month to date, or quarter to date. They're usually around the same. This is what we're looking at as swing traders. As day traders, it's these two, right? Look for the relative strength in the market, and then go and trade those names within that industry. Once again, I'm only showing industries instead of sectors because sectors is just a little bit more boring, but it's the same concept with sectors. Your XLE, K, Y, etc. All right, so closing thoughts. Bulkowski tested a system that used industry relative strength data and found the following. If you buy all of the stocks, so this is where I said sometimes the first portion of his study or whatever, he bought all of the fucking stocks in the industry, and we don't do that. So he did clarify in the second portion of his study, which he updated in 2009 or something, 2010, that he only chose the top 3 stocks and it actually performed better. Just want to throw that out there. But for the first portion of the study, he bought every single stock in the industry. He held them until they fell below 14, and then he sold them. He made on average 28.1% per year from 1995 to 2007. That's like hedge fund types of percentages. Now, nobody in their right mind can go and buy every single fucking stock in an industry. So this is a number. This is theoretical, I should say. This is absolutely not applicable to the normal retail investor or trader. We do not have enough money to be able to do this. But it is showing you that if you think of the industry standard of SPY giving us 10%, which is more or less what it did over that time frame, I'm assuming, you would have, we'll say, doubled buying the stuff that was out competing SPY. So yes, it is valid. This, in theory, is very valid as an applicable trading edge. It is also valid. As I mentioned, the method assumes you buy all the stocks in the industry, not just the best performers. The test was not an exhaustive examination of a trading system, so you will want to do your own research and see what works for you and your markets, right? So like I said, the second portion of his study broke down not all of the stocks within the industries. He ranked them, the first and second, third and fourth, fifth and sixth, and he said that buying in between, was it 2 and 4 stocks within an industry, not including the actual ETF itself, was the best way to play this concept. You don't need to do that, especially if you don't have a huge account. If you are interested in this, just try to do, for example, kind of mimic what I'm doing, at least at the beginning. If you want direct exposure, buy the industry or the sector ETF, and then go inside that ETF or industry by going to ETF.com/whatever the ticker is, find the biggest names in there, chart them. And by the way, he did 0 TA on any of this. It was strictly relative strength when he did this process. Imagine if you take this and pair it with a breakout system. It could be a horizontal level breakout. It could be a symmetrical triangle, whatever you like to play. Add relative strength on top of charts that look the best. He did not do that. Is there an edge in what you do when you buy breakouts over horizontal levels? Yeah, absolutely. 100%. You buy a breakout on something, it might have a throwback, which we went over last week, but yes, you have a definite edge. Now imagine going and finding an industry has number 1 relative strength, number 2 relative strength. You break down all of the names, all of the top 10 names, let's say, because some of these ETFs and industries could have a lot. You break them down, you chart all of them, and you find 2 or 3 that are showing breakouts. Not all of them are, but 2 or 3 of them are. Which 2 or 3 are you willing to buy? Probably the ones that are showing the breakouts, right? We did this with SMH. You guys remember when we charted SMH and we looked at AMD, we looked at NVIDIA, we looked at TXN, we looked at AMAT, and which one did we assume as a group was going to do the best? And then it ended up doing the best? Fucking NVIDIA, right? So we charted all of these, and the guys, I think Kyle and maybe somebody else was playing NVIDIA. We charted these. We were like, NVIDIA is great. I personally said NVIDIA is way too fucking expensive for me to play, so I chose the cheaper and ended up being the shittier version. This stuff works. So like I said, this study is only relative strength. Add this with a breakout system or whatever trading system you already have, and this should have amazing results. So I'm going to pause, and then we can dig through this as a group. 1 second.